Ever wondered why a car loses a value the moment you drive it out of the showroom? Now that, my friend, is depreciation for you. So hi guys, my name is Aman and in my channel I simplify basic financial concepts, thus enabling you to have a better understanding of finance. And if in case you are wondering like why I make finance videos, then I have a degree of bachelor's in accounting honors and a master's in finance. Now without wasting any further time, let's just start the today's video. Now let's just understand in simple words what is depreciation. So depreciation is the reduction in the value of an asset over the period of time. Now there can be multiple reasons why the value of asset decreases. It can be of aging, wear and tear, or obsolescence. Obsolescence basically means when a product gets outdated or is no longer useful. And lastly, depreciation also helps in tracking the value of an asset, and it reduces the overall taxable income because the depreciation is treated as an expense. Now moving on to some of the important features of depreciation. So business uses a depreciation in order to spread the cost of their big purchases over several years. For example, if a business purchases a machinery for 1 lakh rupees and every year the machinery depreciates by 20%, then the business has to record the amount of 20,000 every year till the 5 years, because the value of the machinery is 1 lakh. So the 20,000 is being spread over the 5 years. And secondly, it also helps in maintaining the financial statements much more accurate because it helps in determining the value of an asset. And third, it helps in reducing the taxable income because the depreciation is treated as a non-cash expense. Lastly, depreciation also helps in recognizing the cost of producing a product and delivering the services. Now moving on to the methods of depreciation. So the first is a straight line method. So straight line method is a method in which a value of an asset is distributed evenly over its period of useful life. Now straight line method consists of three things. Number one is the cost of an asset. Number two is useful life, which means the expected number of years the asset will be used. And third is a salvage value. Salvage value means that the value of the machine at the end of its useful life. So there is a formula for straight line method, which is cost of an asset minus salvage value by useful life. Now let's just look into one of the examples of straight line method. Now let's just say you buy a laptop of 50,000 rupees and the salvage value is 10,000 rupees and the useful life is 4 years. Now after applying the straight line value formula, now we can see that we would be getting amount 10,000. So 10,000 is an amount which will be distributed evenly over a period of 4 years. Now declining balance method or the written down value method calculates the depreciation as a fixed percentage of the asset's book value at the beginning of each year. Now there is a formula for written down value method as well, which is book value into the depreciation rate. So book value refers to the asset's value at the beginning of each year, and depreciation rate refers to the rate of depreciation, be it 10%, 20%, etc. Now looking on to some of its examples. Now let's just say we buy a machinery for 1 lakh rupees and it is depreciated every year by 20%. So in the first year we can see that if the 1 lakh is depreciated by 20%, then we have the depreciation amount of 20,000. Now from 1 lakh, if the 20,000 is gone, then we are left with 80,000. So 80,000 is the book value of an asset at the beginning of the next year. So similarly 20,000 is deducted from 80,000 as well, and then the book value for the next year, which is third year, will be 64,000, and it goes on and on and on, and this is the written down value method. If this video makes sense, then I would like you guys to check out my previous videos as well. I've put the link down below in the description. Till then, see ya, stay tuned.